Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone had a wonderful weekend. It is Sunday afternoon, December 7th, and this is Matt's Mega Weekend Market Newsletter Review. The reason I call it Matt's Mega Weekend Newsletter is because these weekend newsletters, as you know, are quite comprehensive, anywhere from 70 to 100 charts, and can take anywhere from 40 to 50 minutes to cover everything. But again, it's the weekend, so that's the time to discuss everything. So we've got a lot to discuss. These newsletters are for those who really like to get into the weeds, like to learn technical analysis, and it's not for the short attention span TikTokers out there that can only focus for, a couple minutes at a time. So hopefully you're not one of those folks. Anyway, got a lot to discuss here. You can see the newsletters into 8 major sections. Again, I hope everyone had a nice weekend. We're now entering into the second week of December. So happy holidays, everyone. All right, for the week, we had slight gains for the major indexes. The S&P gained about 0.3%, the Nasdaq 0.9%, the Dow about 0.5%, and the Russell 0.8%. The strongest sectors last week were transports, banks, oil services, which was up 5.7%. That was the strongest sector. Semiconductors up 3.8%. The weakest sectors were drugs, healthcare, and especially utilities. Okay. The market, as you know, had a nice three-wave ABC pullback from late October. It put in a low on November 20th, just before the Thanksgiving holiday week. During that time, the breadth indicators recycled the lows normally seen during much larger corrections. So the market was definitely vulnerable then. We saw a lot of the big high-flying names early in the year, crypto, quantum, the FANG names really get hammered. But the market put in a low, and what's the positive here is that the breadth did come back pretty nicely. And late last week, we also started seeing some of those previous high-flying names, some of the crypto and quantum names, uranium, start to rally as well. The S&P 500 has posted a gain of 9 days out of 10, so it's up nearly 400 points. So the market's in pretty good shape here for this year. So that said, we are a bit stretched here in the short term. What I'm seeing here is a little pronounced divergence on a 60-minute time frame of the VIX, a little positive divergence. So if the VIX bounces here, we're likely to see a little pullback here in the market. Wouldn't be surprised if we get that early this week. I also see some MACD divergence on the 60-minute and 2-hour time frames of the S&P 500 and Nasdaq. So odds favor maybe a pullback here soon. Again, despite the time of year. But then if we do get a pullback, I'm looking for a higher low. Remember that big fat round number of 7,000 on the S&P 500 is only about 130 points away. That is a magnet. Okay. Bond market. One thing I would monitor here is the 10-year treasury yield. It's bounced pretty nicely. We have a possible inverse head and shoulder pattern. I'll show that chart early on. High yield corporate, though, which tends to be a leading indicator in the bond market, is still strong. This week, we have the FOMC, so we'll see if Fed lowers rates again. And the jobs report, which normally comes out the first Friday of every month, will be released next week on the 16th. Commodities look pretty dang good here. BCI and PDBC ETFs. PDBC hasn't yet broken out of its 3-year range, but I'm watching. BCI has been much stronger. Energy stocks have been strong here despite crude oil being fairly weak. Natural gas has been strong with the seasonality. Precious metals, gold has been choppy while silver has been amazingly strong. One thing I saw, you may have seen recently, was one thing that's been pushing the silver market is actually, I think a Chinese firm tried to take physical delivery from the futures market, from the COMEX futures, and they couldn't deliver. So it shows you that they're really not, those futures and derivatives aren't covering or all backed by 100% physical. So that's been putting a little pressure on, upside movement there. Wild cards, to consider still, Trump tariff stuff at the Supreme Court, rules against that, etc. Okay. Let's start with the charts here. So, first chart below, item number 2 is a 60-minute chart of the VIX. That's the volatility index, as you know, generally moves inverse to the S&P. And what you see here, the VIX has come down nicely since late November. It was in the upper 20s. It's now down here in the 15s. But notice there's a pretty good MACD divergence now, and it's at a support level here from late September. So, again, this could be an area to bounce. That would give the market a reason to pull back. But again, I look for a pullback as a buying opportunity, but just this positive divergence in the VIX does gather my attention here in the short term. And guys, if you're on YouTube and you're wondering why I refer to different numbers, it's because on our webpage newsletters, we have numbers next to each chart. So that's why I'm always referencing a number. You don't see that on the YouTube videos here. Next, image number 3, here's the 10-year Treasury yield. I've been monitoring this. As you know, the 10-year has steadily declined since January of this year. It came down into this demand support zone in September, October, found support there, rallied up, pulled back. We got a higher low. We have what could be a potential inverse head and shoulder pattern with this higher low. We got a neckline here. Now, if this breaks out, that would also be a negative for the market and definitely for gold, precious metals, perhaps. So one thing to watch. And again, guys, I know the Fed is going to be lowering overnight rates, but remember, they don't control the long bond. They don't control the 10-year. They don't control the 30-year. So the bond traders have to agree with the Fed. You know, you could have a case where the Fed's lowering overnight rates, but bond traders are pushing long-term rates higher. You know, that sets up a divergence and, you know, something to definitely watch. So next, item number 4, let's talk about some of the KISS systems. So the KISS systems have done very well this year, done their job. Yes, they're not perfect, awesome losing trades. But the beauty about the KISS systems, the KISS trend systems, they get you in, they give you smart trailing stops, they move those stops, protect the stops up over time. And so this chart, for example, of this chart of the Triple Q's S&P 500 or Triple Q's KISS system from the website. Again, this is the daily version. It's been long since April. It's been long this entire time, raising its smart trailing stop up. The stop almost got hit on that last market correction. You know, the 3-wave pullback from late October into November, but it didn't hit and it's still long. So, you know, that's done its job well, keeping you in a trend. Remember, we have intraday versions of this in the high performance area. Next, image number 5, here's Caterpillar. And this is the Caterpillar KISS system. So the system here went long on September 10th. This trade is up 42.3% from that entry. So very nice trade here. And, you know, just an example of the KISS systems keeping you on these trends. Here's Caterpillar that we've had on the website as a trade. And we've had this as a trade probably half dozen times this year. You can see there was a nice tight coil pattern in the fall. There was another wedge pattern here. But again, the KISS system has really been long this almost the entire year. So it's done its job just perfectly. And another one, XBI, that's biotech. So this one has been long since June 10th. It's been long this entire time. You can see how it's just beautifully been raising those smart trailing stops up the entire time. Current stop is 114.70, trades up about 43.85%. So again, it's raised its smart trailing stop, looks like a couple dozen times at least, keeping it tight enough to, you know, keep those profits locked in, but keeping it wide enough not to be hit on noise. So great example of the KISS systems. You know, if you have a subscription to Breakpoint, you don't have a subscription to the KISS systems, you should definitely look into it. Again, the beauty of the KISS systems is that it provides you a systematic way to trade. Remember, we always state to have a plan, have a trading plan. Well, most traders out there really don't have a plan. They don't put stops in place. They don't have discipline. And the systems have discipline. Again, they're not going to have perfect winning trades all the time, but they have the discipline. They have the stops. They give you an exit plan, and they do very well, especially in trended environments. So definitely look into that, guys. All right, let's move back to the general market analysis. Oh, before we get into that, item number 8, here's the example of some of the high performance KISS systems on the website. And, you know, these are various time frames. IVV 60-minute, that's an S&P 500 component. Non-leveraged You could see all these, some of these had gotten out, went to cash during that correction, but they righted themselves and then went right back long. So they're doing well and in this uptrend. Next. Now we'll go back to the general market newsletter at hand. So item number 9 shows the index sector table, what transpired last week. Again, you can see the gain for the indexes. Okay. The Nasdaq 100 led, followed by the Russell 2000, which has been stronger lately. It's recently tested its all-time highs. As far as the 21 market sectors, a lot of green here. Again, weakness in some of these defensive areas. Utilities were the weakest sector, down 4.5%. Drugs, healthcare, those are all defensive areas. Biotech. Also some weakness in materials, home builders, real estate. Not surprising with the rate. Interest rates, long-term interest rates, the 10-year rallying, and a pullback in consumer staples. That's also a defensive area. But you can see the other sectors, transports, really nice gains, banks, energy, oil services especially, that was the strongest sector last week, technology, semiconductors. Currencies, US dollar, nice pullback last week, down about 0.5%. Cryptocurrencies, Ethereum ended up slightly while Bitcoin was down. Remember, they've all rallied off their lows. Commodities, mostly to the upside here. The weakness you see here is in some of the ag area. Otherwise, the index, DBC up about 1.2%, crude oil up 1.2% as well. Natural gas up 11.1%. It's following seasonality, guys, just perfectly. So this has been a great swing trade. It also tends to react with the colder weather. That's why it does generally well during the fall. And we've had some colder weather here recently with all the snow. Copper up 3.3%. Uranium bouncing back nicely. That was a high flyer this year. It had a nice pullback, but it's bouncing here as well. Precious metals, gold up down 0.4% for the week, but silver up 3.4%. Remember, this hit $59 an ounce recently. And platinum and palladium were mixed. GDX, the miners were down. So with the mining stocks down, I am cautious in this area right now, the precious metals. We're seeing a little bit of arbitrage with the silver market, but gold is definitely lagging. And as far as the bond market, we saw a nice bounce, rallying to 10-year, 30-year treasury yield. So you want to keep an eye on that, guys. All right. Next, item number 10 shows the economic news calendar for this week. We have the FOMC on Wednesday. That's the big one. On Tuesday, JOLTS, job opening, productivity, etc. All right, let's go and jump to these index charts. First chart below, item number 11 is a weekly snapshot of the 5 major indexes. You can see nice rally back the last couple weeks. You can see the major index essentially bounced off their middle weekly Bollinger Bands. That's the same as the 20-week MA. You can see, S&P almost back to its highs. Nasdaq not quite, getting close. And the Russell also, this is just about back to its highs here. So nice rally back here the last couple weeks. Next, moving on to the S&P 500 charts in particular. So chart number 12, here's the monthly view of the S&P going back to the 2009 lows. Just showing, again, the bigger picture. Nothing's changed here. We've been in a secular bull market now for 16 years since the 2009 bottom. And so no changes. Now this shows a hypothetical wave count. Remember, wave counts can change. Now, if this count is correct, we are in a 5 of 5. So once this ends, maybe next year sometime, we might have a nice pullback, but for now we're still in the channel. And the 7,000 round number isn't too far away now. Next, chart number 13, here's the weekly view of the S&P. Again, you can see how we bounced off that middle Bollinger Bands 3 weeks ago, just before the Thanksgiving. Nice rally off there, and we're almost back to the highs. The round number of 7,000 is just a stone throw away now, just over 100 points. That said, guys, one thing to watch here, on a new all-time high, we will likely, or we could set up some MACD divergence here. Notice how the weekly MACD lines have crossed. So likely, if we rally to a new high here, the MACD will be at a lower high. So we will have a divergence there to potentially monitor. Next, chart number 14, moving on to the KISS system. So here's the weekly view of the SPY KISS system. Again, the weekly KISS system, again, as you'd imagine, it's going to have wider stops. So smart trailing stop, 636 here. Again, no real changes here. Notice on that sell-off a few weeks back, we had that white volume capitulation bar. That's white. That's climax down volume on this better volume indicator. That's one of my favorite signals, is whenever you get a sell-off and you get these white volume bars. So that's why I like to have these on the chart. But no changes here. Smart trailing stop is 636, pretty wide at the moment. Again, it's a weekly KISS chart, so to be expected. Next, chart 15, here's the daily SPY KISS system chart. And again, this has been long since April 9th, so it's been long this entire uptrend, okay? Smart trailing stop has still been stubborn here. It hasn't moved yet. It's still at 646.24, as you can see. But otherwise, again, the system's been long since April, early April, so it's done a damn good job about keeping you in this higher uptrend. And you can see also on that last, or the sell-off low, that big down volume, notice how we had the white capitulation volume there, which marked the bottom. You can see it marked the white capitulation volume. Notice how it conveniently occurs near these market lows on these pullbacks. See that? And you even had it there in early April at the lows. Okay. Otherwise, this KISS system also has the reversion to mean R2M charts, or reversion R2M mean reversion trades that are an offshoot of the KISS system. They use the smart trailing stops, so they have stops unlike traditional mean reversion systems. The last one closed out there in early November, so otherwise the KISS system is still long. Next, chart 16, here's the triple Q's daily KISS system. So this system's been long since April. Again, it's been long this entire time. And stubbornly, we don't have a new smart trailing stop in here yet. It's still stuck at that 580.59, which was almost hit on that pullback into late November. You see that? Almost had it. It was just a few points away. So it did a good job about not stopping out there. The last mean reversion trade closed out just over a week ago for a slight winning trade. The KISS system is still long from April, as I said. Also notice that pullback low, you had that white volume capitulation bar. One thing to note, short term, we have a DeMark 9 here. Those are generally watched. Again, sometimes you can get a pullback from those. You can see the last DeMark 9, the last couple of them. So just noting there's a DeMark 9. We're up near this ATR. And we are a little stretched here in the short term. Again, we've been up basically 9 out of 10 days. So could be due for a pullback here early this week, perhaps. Next. Back to the standard chart. So chart 17, here's the standard daily S&P chart. Again, you can see the lows in early April, the April 7th low. We've had a series of higher lows during this entire uptrend. You can see the three-wave pullback, ABC pullback from the late October highs to the late November lows just before Thanksgiving. Notice how we conveniently bottomed right at the 100-day moving average. So besides the 200-day moving average, that 100-day moving average is also widely followed by institutions. So again, ABC, three-wave pullbacks are your friends and uptrends, and that ended up being a nice move. We broke the channel. Last week, we kind of stalled around this little supply zone most of the week as expected. A little poke through it on Friday, but again, we'll see what happens early this week. Next, chart 18, here's the 2-hour view. So you can see how we were stuck in that supply zone a lot of last week. So we're still around this area. There was also a little open gap. I don't have it marked here, but you could see from back in late October. So that looks like that was filled on Friday. Again, short term though, there is some pretty obvious MACD divergence and RSI divergence. So again, we could see a pullback at any time here. Notice there's an open gap below that could be a target if we get a nice little rug pull here. But ultimately, I'm looking for a higher low if we do get a pullback. Again, we either pull back here or we just rally up and make new highs, given the time of year. Hard to say. You can also see, guys, just from an educational standpoint, that low in late November, how we undercut that October support and then rebounded. If you ever see that in the future, you got to be careful about those. Those are bear traps. Again, you can break support and continue lower, but sometimes you break support and reverse. So that's why if you're trying to short a breakdown of support, you want to be cautious, or you want to be willing to reverse that trade on a dime if you have to, because those can be bear traps, and that's what it was. All right. Next, chart 19, here's a 60-minute chart just showing the same thing. Again, remember I labeled that lower high in early November as a wave B, so that ended up being the perfect labeling, A, B, C. We had a nice MACD divergence at those lows, nice rally up. You can see the little channel here. We're not too far from the all-time highs at 69.20. Again, do we pull back here first, or do we just go right up there is the question. We have an open gap below. Here it marks some demand zones just to watch. Okay, would be big support areas. We do have the pretty obvious MACD divergence. Next. Chart 20, here's the 4 time frames with the custom indicators, the ATRs, the cycles, and the DeMark. So really, all I want to say here is the ATR is supporting all these time frames, even down to the lower time frames. So really not saying too much here at the moment. Next. Chart 21, moving on to the Nasdaq. Here's the Nasdaq triple Qs. Again, nice bounce the last couple weeks, right off that 20-day weekly moving average, off that demand zone. Okay. The Qs are a little bit weaker on this bounce, while the S&P and small caps are basically right back to their highs almost. The Qs are still a little bit above that, or still below that. Next, chart 22, here's the daily triple Qs. Again, just like in the S&P, you had a perfect 3-wave ABC pullback. Okay. We've rallied up. We've kind of stalled around that demand supply zone last week a little bit. Little Pinocchio move from there, but there's an open gap here that's hard to see, which I'll show you on the next chart. Chart 23, here's the 2-hour time frames. You can see that open gap. So we got into that gap last week before pulling in. We do have a little MACD divergence here, little RSI divergence now. Again, whether we just rally to test the highs and to blow out divergence or pull back remains to be seen. Okay. Next. Reviewing some of these FANG beta type stocks. As you know, some of these were quite weak on the pullback. Here's Meta. It actually topped out in August, but it had a really nice bottoming look here in mid-November, which I pointed out a long trade there, and it worked out. We're now back to the 50-day moving average. Next. Chart 25, here's the 2-hour view. This was the way to trade it. This really bullish falling wedge pattern with MACD divergence. Whenever you see a wedge like that with divergence on the MACD, that's one of my favorite setups. So this has played out nicely here. In fact, you could still be long this. Next, chart 26, here's Google. Google's just been in fuego, still holding that 9 EMA. As you know, Buffett recently bought into this, had a nice little breakout recently, still holding here very well. Chart 27, here's Apple. Apple's been holding here well. Broke out of this little channel flag a couple weeks ago, but it's pulling back here. There is a little bit of MACD divergence to watch here. Otherwise, you can watch this uptrend line, 20-day moving average as support. Chart 28, here's Microsoft. It had a double top back there in October, bounced off the 200-day moving average, and then last week stalled around that back test of the previous support, became resistance. So we'll see if it can hold that area. It needs to take that area out. And chart 29, here's NVIDIA. As you know, NVIDIA has been declining. Now it's retesting near these downtrend lines. So this is the area to watch. Again, should the market rally to new highs, I am looking for NVIDIA to eventually go back up. But for now, it's got to clear this resistance area out. 20-day moving average, 50-day moving average, and trend line. And finally, chart 30, here's IONQ, just showing you one of the quantum stocks. So, you know, a lot of the stocks that's been high flying, they had big pullback corrections in October and November, but they all started to bounce last week, over the last couple weeks. You can see how this bounced off a demand zone. So this and the uranium names, quantum names, they've all started to bounce. Okay, finally, chart 31, here's IWM small caps. This rallied nicely, retesting the recent highs. So we'll see if we get a little pullback here. But any pullback here, I would still view as a buying opportunity. I think eventually this breaks out to another high. And chart 32, here's a 2-hour view. Notice this nice rally. We do have potential 5 waves up at this high, so you got a potential double top up here and a pretty obvious MACD divergence. So this would, like I said, this would be a logical area to pull back. One thing I should have added was the demand zones. You're gonna have a demand zone right here in this area between the 249 to 245 area. So that's your next demand zone into there. Okay. Chart 33, here's a 60-minute view just showing the same thing. Oh, here I have some demand. So first off, you can see the nice rally from that divergence in mid-November. Nice kind of a wedge pattern there. Rallied up, that looks like some sort of wave 3. You get a little wedge pattern there and then a rally to retest those highs. Here's your next demand zone. So right here between the 250 to 248.50 roughly, and then there's another demand zone down here, and then you have your fibs. Okay, so that does it for the major indexes, guys. Let's move on. Chart 34, here's the VIX. Again, as you know, the VIX had closed below its lower Bollinger Bands a few weeks back. Those were VIX Bollinger Band buy signals from the market, and those have obviously played out. Okay. Next, chart 34 or 35. Here's the breadth thrust that I was speaking about the previous week. Remember, this had a nice rally from the oversold condition, but I know some folks were looking for a potential confirmation of the breadth thrust. Well, given that fact that this breadth indicator has moved down, this is not going to get overbought within the required 9 days. Remember, it's got to work from oversold to overbought within 9 days. So that's not going to confirm. You also have a little divergence here now. Okay. That said, though, this indicator is a good indicator as a mean reversion when it gets oversold. You can see I marked this with all the little arrows. Every time this gets oversold, gives you nice little buy triggers. Okay. The last breadth thrust indicator triggered on April 24th. You could see right here when it went from oversold, overbought within the 9 days. And obviously that was a nice breadth thrust signal. It makes sense we don't have one here, guys, just because, again, generally you get these breadth thrust signals off of a major low after a correction, not, when you're near the highs. So not surprising. And remember, guys, on the VIX, I meant to add a duplicate chart here, but remember we have that pretty good MACD divergence on the 60-minute time frame. So the chart I first showed. So that could play out for a potential bounce. If it does, maybe we'll see a pullback earlier this week. Next, moving to the bond market, chart 36, there's the 10-year treasury yield. As I already discussed, we have a higher low. We have a potential neckline here. This is definitely something to watch this week. Remember, we have the FOMC this week. Again, the bond traders are not beholden to the FOMC, but we'll see, what it does. But this does potentially look bullish, and if this were to break out, that would be a problem for the market. Next, moving on to the bigger picture, 10-year treasury yield. Haven't shown this for a while. So this chart goes back to the mid-70s. This shows you the big picture, the secular cycle. So interest rates, remember, we're in a secular bear market from essentially late 1981, which all the way to early 2020. That ended a secular bear market for long-term 10-year treasury yield, and we're now in a secular bull market. Okay, kind of similar to the 1970s. Remember, that was the secular bull market for interest rates and for the commodity super cycle. Well, we're kind of in the same thing here. Honestly, to me, this doesn't look done. I wouldn't be surprised ultimately if we see another rally up in the 10-year treasury yield over time. Okay. And let me show you the next chart. So chart 38, here's the 10-year on a monthly chart. You can see this potential wave count. I drew this, man, I must have drawn this over a year ago, but under this count, you have a potential nested 1, 2, 1, 2. So you have 1, 2, 1, 2, 3, 4, 5 of 3. If this is the correct count, we're working on a coil pattern, which would be a wave 4. But eventually the coil will rally to new all-time highs in a 5. Well, not new all-time highs, but highs that will take out the 2023 highs. So again, that's despite the fact that, Trump wants the Fed to lower rates, or the next Fed chief that's going to come in after Powell may aggressively try to lower rates. The 10-year isn't confirming that. The 10-year is more saying, hey, no, we want to rally up again. So, and guys, just a little soapbox. From what I read about the new Fed chief after Powell, I've heard they want to aggressively lower rates. They may want to start QE again. If they do all that, honestly, guys, inflation could be a huge problem, and really what you want to be in assets, because that's what's going to accumulate. Being in large amounts of cash is not going to be good. Okay, being in large amounts of cash that'll be where people will get hurt, and the gap between the haves and have-nots will only get wider. Okay, for folks with assets, gold, precious metals, stocks, real estate, they will appreciate. But folks who just have cash or just work paycheck to paycheck with no assets and just rent, they will be the ones hurt the most. Next. Here we go. Chart 39, here's high yield corporate. So high yield corporate, remember, this is a leading indicator. So anyway, it continues to lead here. So no changes here. There's a little divergence here, but otherwise it is still uptrending. Remember, the S&P tends to follow this. That's why we really keep an eye on it. Next, chart 40, here's the 60-minute version of the S&P versus high yield corporate. So this has been an outstanding indicator. Early warnings for market inflections. You can see we had that divergence in early October when you had that lower high on the high yield corporate. Well, that led to a pullback. Then you had another divergence there in late October. Of course, that led to a big market pullback. Then you had a little positive divergence there in early November that led to a bounce, a lower high. Then you had another positive divergence at the mid to late November lows that led to the bottom. Right now, you have a very slight divergence here, but not a pronounced one like you did back there. But we'll keep an eye on this, folks. All right, moving on. Let's review the market sectors. So chart 41, here's the transports. They had a great week, up 3.85%, broke out to new highs. Next, chart 42, XOK technology. It was up about 0.75%. So still lagging here. You can see volume still light. It's also into the supply zone. Now, the moving averages here bunched up would be a support, but this is still lagging. Chart 43, here's the MAGS, Magnificent 7 ETF. Again, similar look to the S&P with the three-wave pullback. There is a little resistance coming up here. You're going to get a lot of support at the moving averages below. Next, chart 44, financials. They rallied nicely off the 200-day moving average a few weeks back. So they're approaching their highs. Banks also had a great week. I'm not showing that tonight. Next, chart 45, biotech. This sector has been in fuego. Remember, I showed you that KISS system, which has been long pretty much the entire time. Parabolic uptrend here, but continues just powering higher. Next, chart 46, real estate. This area has been just essentially going sideways most since basically May. So one to watch here, especially if rates were to go higher, long-term rates. Moving averages are all flattened out here, so this definitely leaves us a bit vulnerable. Chart 47, here's the 60-minute chart of IYR. Notice we have a potential little bear wedge here, a little bear pennant, a little coil. Okay, so this suggests a possible break to the downside. And a way to play a pullback in the real estate area would be the DRV ETF. That's the XXX ETF. You can see the nice base here. It hasn't broken resistance, but one to watch. Or if you wanted to be along a little bit with a stop at that higher low, that's another possibility you could look at. Next, chart 49, XLI Industrials. Took out a little downtrend line last week. Again, you can see most of the sectors are pretty healthy here. Chart 50, utilities. Now this sector has been declining. It was the weakest sector last week. You can see it topped out in mid-October. Recently lost support of these 50-day moving average. Here I added the next demand zone down there. Actually, if price gets down into there, likely the 200-day moving average will catch up to it. Next, chart 51, XLE Energy. This has been a nice, strong sector. Notice it tested its March highs last Friday before pulling back, but I do like this sector, and I like a lot of the stocks in the sector. Chart 52, here's XLE on the weekly, up 1.5% for the week. I like this weekly potential inverse head and shoulder pattern. The oil services was the strongest energy sector last week, which I'm not showing here this evening, but that's another great area. Next, chart 53, ExxonMobil, major stock in that area. Again, looks very nice, as you can see on the weekly chart. Chart 54, NOG, Northern Oil and Gas. This is one of our recent long ideas I've had in the newsletter. Had a little nice inverse head and shoulder pattern here. This was a great trade last week, breaking through that 23 neckline. Notice you tagged the 200-day moving average before pulling back some. That was in order to take some profits. And chart 55, here's the S&P oil and gas exploration. So this is a potential MATS macro vision play. Notice you have a potential monthly inverse head and shoulder pattern, about a 10-year inverse head and shoulder pattern. So definitely an interesting chart potentially for the longer term. And chart 56, talking about the world markets, they've also continued to do. They've done better than the U.S. markets this year. Remember, I made that call back in January, early this year. Anyway, one thing we're watching is these ratios. Here's the EFA. That's the world, one of the world markets. And this is the EFA to SPY ratio. You can see how EFA has underperformed U.S. markets since 2008. But notice you have this divergence here. You got a long-term downtrend line. You got the moving average ribbon trying to curl up here. You have this resistance area in the RSI just over the 50 area. So this is one thing I'm watching. If this ratio can eventually break through this downtrend line and these other things confirm, the world markets are the place you want to be overweight in, say, 401k type portfolios. Next. All right, moving on, we're going to look at the commodities, but first off, here's the dollar. So the dollar down about 0.5% last week. So we'll see, guys. I have been calling for the dollar maybe to rally to one of these fibs over time, but for now, pulling back the last couple weeks, of course. Next. Chart 58, here's the daily chart on the dollar. So far, we have a potential ABC here. Here, added a little demand zone. Let's see if this demand zone can hold. Otherwise, the dollar, if it starts to bounce, it needs to clear and get back above that 200-day moving average. Okay. Notice the moving average ribbon's also pinching here. So this is a support area. It's a break point, just like the website. Next, moving on to crypto, chart 59. Here's Bitcoin. We had that bounce off the demand zone a couple weeks ago in November. Bounced, pulled back, higher low, but found support at the demand again. And now we'll see. Here are the dotted lines. This represents what could be just a one-to-one symmetry. So we haven't even messed with that. And on a bigger move, this is your next supply zone above, right around that 50-day moving average. Next, chart 60. Here's MSTR. I've been showing this lately. MSTR MicroStrategy. No, this got absolutely hammered, down 66% just off the July highs. That's crazy. But week ago, 2 weeks ago, I said, might have been worth a shot, for an aggressive, one of you aggressive traders, just take a little shot at it. So, minimum if this retraces some, this could be a nice bounce. Still hanging in here though. We do have a little divergence at those lows. And chart 61, here's MSTR on the 2-hour. Notice that MACD divergence you had at the early December lows. Now we'll see if this can form a higher low. I still own a little bit. And again, guys, all these other various crypto stocks, should the market continue higher, should Bitcoin continue higher, they should also as well. Next. Here's Ethereum, the weekly view. Remember, this had a nice pullback all the way down to this demand zone. I thought it was worth a shot taking some there. Remember, this is part of one of my long-term ideas, so I was looking for a pullback, and this was a good support area. So we did get down to that demand zone. Chart 63, here's the daily. Similar to Bitcoin, tagged that demand zone in mid-November, bounced up, then pulled back again, higher low. It's trying to bounce here a little bit this weekend. All right, moving on to commodities. So these indexes are looking interesting. Here's PDBC. This is a broad-based commodity ETF. There's no K1. It is a little bit weighted towards energy though, but notice you're testing this channel. We've been in this channel for about 3 years now. So on a break of this channel, I think this could be a long-term swing play. Next, chart 65, here's BCI. Now this is a broader based ETF. It's not as much energy weighted. Okay, also no K1, which is good. So this looks really good. I've been holding the swing trade in this and continues to look good. Nice rounded bottom it's coming out of, kind of a cup and handle look longer term. Next, chart 66, crude oil. Again, energy stocks have held up well despite how weak crude oil has been. It bottomed here in mid-October. We got a potential higher low there at 57. Trying to take out a little trend line here. Now we need to see some follow through. And here's the tradable ETF USO, similar look, obviously. Next, chart 68, UNG natural gas. This sucker's up 11% last week. This has been beautiful. You can see this beautiful rounded bottom here. You can see the double bottom there in October. That was an area I pointed out as a low risk long. I've been holding the position in UNG since then. It's been a great swing. Remember, UNG tends to move with the weather. It's seasonal. That's why it topped out here in the spring, sold off during the summer. The winter months, it's colder, so it's used more and it tends to be stronger, and it's just following it perfectly. Last week, gapped above its 200-day moving average. Here's your next supply zone. But again, take some profits or move your stops up, but it's been a great swing. Next chart for 69, here's DBA, agriculture up about 0.4%. Could be forming a big weekly coil here. Again, this is kind of a Matt's macro play really from back here in early 2024 off this cup and handle that I had pointed out. Next chart for 70, copper. I'm just showing the tradable ETF or ETN, CPER. There's a supply zone up here. Now the actual commodity CP $COPPR actually tagged this, but I'm showing this as the tradable. You can see it broke out of a coil here recently. And chart 71, here's uranium. This also, remember, this was weak during that correction. This came down into the demand zone, bounced up. Right now it's at its 50-day moving average. Here you could add a trend line here. I'd watch this area right around the 49.60 area, see if we can break through that. One of the high flyers, Oklo, in the uranium area, nuclear area. This also had a nice correction from 193 to 79. Think about that, guys. What percentage is that? That is 60, 70% pullback, but came down to the demand zone. That was definitely worth a shot. Man, if you bought this demand zone in the low 80s, I mean, the moves on some of these suckers is crazy how quickly they can move. Next chart 73, here's Remax. That's Matt's macro play from back in June. The rare earth ETF. This sector, as you know, rallied over 100% from my entry back then. Right now, we got a coil forming here. So again, this area may try to bounce here again as well. Next chart 74, here's platinum, another Matt's macro from back in March and April, May. This sucker had that beautiful monthly coil pattern. Again, rallied from there, in the 900s all the way to 1700. It's been an amazing swing play. Congrats for those of you who rode that up. Next chart 75, here's platinum on the daily, PPLT, the ETF, still holding here well. Remember, we had that nice wedge recently, so gapped out of there. And chart 76, here's a way to own both platinum and palladium, SPPP. So this is one I like because you can capture both. I like both platinum and palladium. Bounced off, retested that area, became support. Chart 77, platinum on the weekly. Again, I like this nice rounded bottom, saucer bottom. So this is a Matt's macro play. It has been since April. I think over time we'll make it up to one of these fibs, which would be a great swing trade. Next chart 78, here's moving on to gold, precious metals. So gold kind of lagging here a little bit. Silver's been the star here lately. Still watching this area. Can gold make another high here? Or is it going to form a lower high is the big question. Next chart 79, here's the weekly view of gold. Remember, this was the Matt's macro play from early 2024 because it came out of this weekly base. Fundamentals supported it, just went in fuego. Highs were at 43.81. Again, I'm viewing this as a wave 3 of 5. Now, whether we can make a new high here or this forms a lower high remains to be the case here. Next chart 80, here's another bigger picture view of gold. It shows you one of the potential wave counts. Here I added a couple trend lines. Again, it is quite extended here, guys. It is possible if this forms a lower high, it may need to work to one of these longer term trend lines over time. Chart 81, here's the inverse ETF GLL. So if you do get a trigger here, this could be a way to play a pullback on gold. All right. Moving on to silver, chart 81. Silver, as you know, this thing has been in fuego, hit basically $59 recently. And as I already commented, silver's been stronger than gold, broke out of this coil. One of the reasons is because of the arbitrage in the silver futures market. They were unable to fulfill a delivery, which shows you the problem in that area. Okay, they don't have enough. Chart 83, here's the 50-year chart of silver, just one of my absolute favorite charts. You have a 45-year ascending triangle pattern. As I said, third time's the charm. We took out that 50 area. Remember, that was resistance in 2011, 1980, where the Hunt brothers tried to corner that market. Became, inspiration for that movie Trading Places with Eddie Murphy and Dan Aykroyd. But again, breaking through here. This chart measures conservatively to 85 over time, guys. And the ultimate measurement would be up around 100, which is insane. Next, moving on to the stocks, they are lagging. So that's why I'm a little bit cautious here unless the stocks can start rallying here. Here's GDX here. You can see the pattern's still okay here. It's still holding the 9 EMA, but it needs to take out that resistance. He did get a bounce off that flag pattern recently. Jabber 85, here's the 2-hour view. So you can see there was an open gap that was filled. We'll see here, but again, the stocks are lagging here a little bit short term. And finally, guys, I want to cover some trade ideas. We've had some awesome ideas here. So here's TE. So this has been I added this long idea over a week ago. You had a daily chart, you had a 3-wave pullback. Volume was excellent. You were breaking through this channel on expanding volume. Well, this sucker had a big rally last week. And take a look at the weekly. So here's the weekly, up 41.5%. Look at this move. So again, I said this looked like an easy trade up to that 6.5 area. You can see that's previous support, became resistance. So I think at minimum it goes up to there. This has been one heck of a swing, and I like it coming out of this base, and it's an energy stock. So you may get a lot more out of it just this area. But again, guys, up 41% in a week, hell of a move. Next, Jabber 88, CRML, another nice trade. I put this out a couple weeks ago. This is one of those what we call Christmas tree patterns or mountain patterns. It's basically rally all the way up, all the way back down. But the fact that it came all the way down to this demand zone, MACD was starting to try to curl up here. It looked like a low risk trade in this demand zone, and it was. So really nice percentage move. You bought it there in the 7s. It's all the way up in the 10s now. Next, Jabber 89, ASTS. This was actually given to us by one of our subscribers. Kind of a competitor to Starlink. Again, this sucker was down 60% from 103 down to 49 into a demand zone. I thought it would look like a great low risk long here. Well, last week rallied all the way up. Now it's some supply, so if this is just a trade idea, you might want to take some off here. But a great trade. Next, Jabber 90, APA. I think it's a natural gas play, recent breakout idea of ours. Broke out nicely last week. Jabber 91, Rivian was a nice long idea. Nice bounce off the 50-day moving average. That said, it's had 9 consecutive days up here, so little doji inverted hammer on Friday, so it is a bit extended here. May need to pull back. That said, I like the weekly. I like this big long-term base that it may be trying to emerge from. Next, let's talk about Pfizer. This is one of Matt's macro vision plays, long-term swing plays. This continues to work out. Again, it's kind of been a slow mover here. Nice buy off the 200-day moving average, but it's steady Eddie. The reason I like this longer term is because I think this pharmaceutical area is bottomed, and I like this monthly chart here. The monthly chart completed a 5-wave Elliott wave pattern correction from the 2021 highs to this year's lows. So after 5 waves down, I look for a decent retracement, say back to one of these areas. That would be a heck of a swing over time. Next, here's a couple other ideas. MIRM, this is a potential short if you're looking for a short. See that? Not a lot of support down in this range. Jabber 96, AMD, I've added this as a bear wedge. It's still viable here. Maybe one to watch this week. And guys, that'll do it. We'll see where futures here open later today. Again, I want to thank you for everyone who's supporting us at Breakpoint Trades. As you know, it is just me now. Again, it's me who does all the newsletters, but we have amazing folks here. We have James, we have Rick Kwan, who many of you discussed, and again, we have a great team here. Been here since 2003. So again, hope to continue this, and I hope to help you guys profit over time. Again, enjoy the rest of your Sunday. Take care.